Hello, and we are live. Thanks for joining. Like last week, I think I will give it a minute or two to let some more people trickle in. This will be about understanding Roth IRA withdrawal rules, which is incredibly exciting stuff. Very important, also very exciting, thankfully. So let's give it another minute here. I will read you 3 dad jokes like I did last week. First one, I like this one. I had a dream my ship sank in an ocean of grape soda. It took me a while to figure out it was only a fantasy. Get it? Fanta. Yes, that one's not so good. These get better in order. I put that one first for a reason. Number 2, why did the tomato blush? Because it saw the salad dressing. Yep. And finally, this is one of my all-time favorites. 2 peanuts were walking down the street. One was assaulted. Right. I teach at Rutgers. Historically, it's been the graduate students in the MBA program for the finance department. This past semester was undergrads, and I did try to warm up the room, one of the classes, with a dad joke. You know, these are 19 to 20-year-old kids. I can't tell if it went over well or not. They definitely chuckled, but it was like a awkward, oh my God, I can't believe he's doing this kind of chuckle. I told them 2 peanuts were walking down the street, one was assaulted joke. Didn't quite get the response I was hoping for, but who knows? Maybe they were just nervous and not quite sure who this weird dude is in front of the class, supposed to talk about finance, but instead telling jokes about peanuts. I don't know. Anyway, so thanks for joining. Again, this will be Roth IRA withdrawals. It ended up being more technical and meaty than I thought it was going to be. You know, I was thinking through the rules. I know them; they make sense in my head. I started to put down on paper and sketch out how I plan on this flowing, and I was like, wow, this is lots of little rabbit holes. You know, these rules are convoluted. Sometimes they apply, sometimes they don't. I'm going to go through it all, and because it was sort of more convoluted than I was hoping it'd end up being, I do have a neat and pretty slide at the end that sums up everything in a real clean, easy to understand way, and I'll share that with the group after the fact. I'm also doing my next YouTube video in the Retirement Planning Demystified channel about this. It's already in the works. I'm just about finished up with the script, and I'll be recording it tomorrow probably. So whatever you don't, whatever doesn't quite soak in or 100% make sense here, definitely check out that video in the Retirement Planning Demystified YouTube channel in the next day or two. That'll have a little more explanation and detail behind it. And it'll be scripted and hopefully better thought out than me just kind of sitting here at a high level ad hoc in it. But so that's that. Everyone here knows the benefit of a Roth account. You pay tax when you put the money in. That's the downside. The upside is when you take it out, it's all tax-free. All the growth and when it comes out, it's tax-free in most cases. Now, anytime someone asks a question about Roth IRAs, that's always my response is it generally comes out tax-free or normally tax-free or should be tax-free if you meet certain qualifications. Well, tonight we're going to be talking about those qualifications, thankfully. Before talking about how to take money out, first you have to understand the ways to get money in, because that, depending how you put the money in, depends how the money comes out and how it's taxed, if at all. And feel free to post comments, questions along the way. I do see there are some comments here, so thankfully the comments are working tonight, which is good. So to get money into a Roth account, and there's someone in the group asked this the other day, can you contribute stock into a Roth account? And the answer is no. You can only contribute cash. You cannot contribute property. And cash obviously isn't just actual bills. It's you send in a check, or you can do a wire from your bank, or an ACH bank transfer from your bank to your Roth account. But the gist is just cash. You can't take a share of stock from a brokerage account and contribute that into a Roth. So the ways you get money in are contributions. You directly put money in. We'll discuss this next week, which is the how to do a backdoor Roth contribution. But your ability to contribute is based on, first, you have to have earned income, either wages from a job or you have your own business and have self-employment income. But you need earned income to be able to contribute to any IRA, traditional or Roth. If you don't, you flat out can't contribute, period. If you do, then good, you can contribute. But at some point, if your income's too high you get stopped out from being able to directly put money into a Roth. We'll discuss those limits next week, but it's a little over 200,000 if you're married, and 120 something if you're single. But let's assume you are able to contribute. So this year you can put in $6,000 if you're up to 49 years old, or $7,000 if you're 50 years old or older. So contribution is one way. And there's really only one other way. The second way is what's called a conversion. That's where you have money in some other account, a tax-deferred account like a traditional IRA or your 401k or 403b at your employer, traditional tax-deferred money where you did not pay tax when you put the money in. You can take some or all of the money in that tax-deferred account and convert it, basically take it out of that tax deferral world, put it into the Roth world. Now, upon the conversion, you may or may not have to pay tax on that conversion. This is where it gets a little technical, so I'll try to keep it high level, but refer to the forthcoming video and the YouTube channel if you want some more clarity on this. If you, for example, you have a 401k at work, and a lot of 401ks, well, all of them have a tax-deferred option. Some also have a after-tax option. Not a Roth necessarily, but an after-tax option. So let's say you max out your $19,500 tax-deferred contribution to your 401k. If you want to put more in, you usually can, but you can't get tax deferral on it. So you have to pay tax on the rest of your money, and you can put in, it's potentially up to $37,000, give or take, of after-tax money you already paid tax on. You can then eventually take that after-tax money in your in your 401k and convert that to a Roth. Since you already paid tax prior to it going into your 401k, you won't be taxed again when you swing that money over or convert it to a Roth. That's a non-taxable conversion. On the flip side, and more common, is you have a regular IRA, let's say, tax deferred, all the money you put in there you never pay tax on. You want to get some of that into a Roth. Well, you can convert some of that IRA money, put it into a Roth, and upon doing so, you would have to pay tax because, again, it was never taxed, the money that was in the IRA. So to get it into a Roth, you have to pay tax upon that process of converting it. That's a taxable conversion. So there's two types of conversions, taxable and non-taxable. So that's really it. That's the only ways to get money into a Roth is directly contribute, if you're eligible, or convert, and that sort of has two subparts, taxable or non-taxable conversion. Now, there are some other weird, very specific one-offs I'm not going to get into, and they don't apply to most people. For example, I just found this out last week, but people who received a settlement from the Exxon Valdez oil spill in 1989 in Alaska, they have a one-off ability to take some of their settlement money and put it into a Roth IRA. Go figure. Did not know that. There's also something for people who died in the military beyond, I think it was October 2001. They're survivors. If they get military survivor insurance, basically, there's a one-off exception for them to contribute to a Roth. But otherwise, you can contribute, you can convert, and that's it. Question. Roth contributions look at your adjusted gross income, not total gross, correct? Correct. It starts with your adjusted gross income. It's modified adjusted gross income. There's a handful of adjustments to it. I don't remember them all. One of them, for example, is in your regular adjusted gross income on your tax return, it allows you to deduct qualified higher education expenses, a certain amount of them. Interest you have on student loans, you can deduct that. When you're calculating your modified adjusted gross income for Roth eligibility purposes, you have to add back in those deductions like student loan interest and qualified higher education expenses. There's a few other tweaks to it, especially things about foreign earned income and some other things. I think there's like 6 to 8 tweaks to your adjusted gross income for purposes of Roth. But yes, effectively it's your adjusted gross income on your tax return with a few adjustments. Good question. So now, that's the way to get money into a Roth. Again, contributions or conversions, and that's about it. Now, I'm not talking about inherited accounts. That's different. When you inherit a Roth from someone who passed, like last week or whenever it was I said it, you don't actually own that inherited account. It's not yours. You're simply the recipient of its income, but the account is still basically owned by the person who passed. So if you inherit a Roth account, that's not getting money into your Roth because it's not your Roth. It's someone else's that you're just getting income from. The one exception is a spouse, as I mentioned before. Spouses have the ability to take their deceased spouse's Roth and put it into their own as if it is their own. So I guess that's sort of the third one, but that only applies to spouses of those who deceased. Another question, a few questions. Quickly, so did a Roth conversion recently? Are the taxes due now or when I file my 2020 return? Wow, that's a can of worms you just opened, Tom. There's no easy answer. Tax withholdings and estimated taxes are really complicated. At a super high level, if you have a job, let's say, and you're withholding taxes from your paycheck, if you happen to be withholding enough from your paycheck to make up for, to cover your regular income plus the conversion you did, then no, you won't need to pay anything else now. Technically, as long as you pay up to 90% of what your ultimate tax bill is for this year, you're good. You won't get hit with any underpayment penalties or whatever. If your withholdings don't equal at least 90% of what your taxes are ultimately going to be this year, then yes, you'll need to make an estimated payment, or you should make an estimated payment. I can't really give much more guidance than that. You really have to dig into it and look at all your sources of income and withholdings. To the extent you're short, you should top it up with an estimated tax payment in the quarter that you did the conversion. So if you just did it, what are we, July? September, what is September? Yeah, you should basically make the estimated payment now. So April, June, yes, by September 15th, I don't think that changed. By September 15th, you should make an estimated payment for this quarter for the taxes on that conversion. Trevor, does it make sense to convert up to the 24% tax bracket to reduce future RMDs? Great question, and that's sort of the essence of retirement planning and what I do in my business. So, I'm a living, breathing, retirement-focused financial planner, and that is the complexity of putting together a retirement plan, is how much do you convert and when, and you're balancing paying taxes now versus saving taxes in the future, with the big question mark being, well, what exactly will taxes be in the future? We don't know. We know they're going to be at least somewhat higher starting in 2026. That's under the Tax Cut and Jobs Act. And I have to believe they're going to be even higher down the road, given all the trillions of dollars of stimulus that were created from nowhere in the last few months. We're going to have to pay that off. So whether or not it's right for you to fill up your 24% tax bracket, I don't know. Without knowing your situation, I can't say. I mean, clients I work with, we do get into that level of detail and really hone in on how much should you convert and when, but you can't say. But yes, in theory, you want to convert when tax rates or your other sources of taxable income are relatively low compared to what you think they will be. But don't convert so much that you bump up your current year's taxable income into some unnecessarily high tax bracket. That's kind of the best I can say, unfortunately. Right, so Elizabeth, estimated payment due July 15th. Right, sorry, yeah, we're only July 8th. Good point. So yes, July 15th would be your estimated payment if you are making an estimated payment on a conversion you just did, Tom. Thank you, Elizabeth. Just looking at another question here. I understand ideally you should always use non-IRA money to pay the taxes generated by the conversion. Is there ever a time where it is acceptable to pay the tax with part of the converted IRA? Good question. I don't think so, because the way the conversion works, if you convert $50,000 from your IRA, it's technically a $50,000 distribution. But the early withdrawal penalty, the 10% penalty you would normally have if you're under 59.5, let's say, that's waived if that distribution is used to immediately go back into a Roth. So if you were to have $50,000 come out of your IRA, all of that 50 should go back into the Roth by way of the conversion, as opposed to withholding 20% or whatever for tax, which would be 10 grand, which means you only have 40 going into the Roth. I wouldn't do that. I would just roll the whole thing directly, then use cash or checking account or some other assets you have outside of a Roth or Roth or traditional IRA, like even a regular brokerage account. Maybe there's some scenario or situation where yes, it may be beneficial. I don't know of one, but I mean anything's possible. But generally speaking, you want to convert the entire amount you take out into the Roth and then just pay taxes out of pocket from your other sources of cash or money. I'll take one more question here and then I'll keep chugging on. So the next question is, Tommy, is there a fix that would allow for a traditional to Roth conversion without tax if traditional contributions were not initially deducted on Schedule 1 but also not reported as basis 8606? Totally understand if this question is too narrow. Yeah, I'm not 100% sure what you're asking, Tommy, but if I can ask you to, either get back to me offline, I'm happy to dig into it more, or next week's topic will be about backdoor Roth contributions, and part of that is inherently doing a conversion. So we'll get more into conversions next week. So either come back with that question next week, or just shoot me a chat or something offline, and I can try to help you out on this question. But yeah, let's put that on pause for now. Thanks. All right, so now that you understand how money can get into a Roth, now you can start thinking about how to get money out, which is ultimately what it's there for, so you can use it down the road. So Roths have a particular order of withdrawals. When you put your money in, when you take it out, regardless when you take it out, whether it's the day after or 20 years after, all the money that comes out is first assumed to come out of what you originally contributed. And then once you deplete all of your original contributions, it then goes to conversions, and there's a little waterfall. So I'll show you here, again with my hokey clipboard in front of the camera trick. So all monies that come out of Roth accounts, every dollar that comes out is first deemed to be considered contributions. Once you have taken out enough that you've depleted all your contributions, you move on to convert money which was converted, if you've done any conversions, that is. And within the conversions, first is the ones that were that you did pay tax upon conversion. Once you've depleted all those, then you move on to the conversions that were not taxable, like I mentioned before. That's if you had money originally in a after-tax or non-deductible IRA and move that to a Roth. And then finally, once all conversions are gone, you're left taking out earnings. So just to throw some quick numbers to this, assume you put $5,000 in a Roth IRA a few years ago. That would be a $5,000 contribution. And assume you just started it then, so that's all you had. Let's assume you didn't do any conversions along the way. So points 2 and 3 don't matter. Your account has since grown to $6,000. So it was your $5,000 original contribution plus $1,000 of earnings. So now, if at any time you take out, whether it's $1 or $5,000, the first $5,000 to come out is deemed to just be you, trying to point upside down here, getting back your original contribution. Once you exhaust taking out that $5,000, everything after that then is going to be earnings. So this order of withdrawals matters. And here's why. So regardless when you open the account, regardless how old you are, regardless of anything, money you put in by way of a contribution can always be taken out tax and penalty free, no explanation, no reason necessary, boom, just take it out. Because it's money you already pay tax on, there's no special incentive or reason for the IRS to want to keep it locked up inside the Roth or slap you on the wrist if you take it out. That's your money. So again, contributions can always come out anytime, no tax, no penalty. So in our example before, you put $5,000 in, it grew to $6,000. You can take out up to $5,000 anytime, period. Easy. Taking out the additional $1,000, that's where all these rules come into play, and that's what I'm going to talk about. So first thing to understand, contributions, zero penalty or tax. You can always take them out anytime. Now, that's for an IRA. For a Roth, if you have an employer who has a 401k plan that offers a Roth option, they may restrict you for various reasons. But in theory, the IRS allows you to be able to take your money, your contributions out from your Roth 401k. But the plan administrator, they're allowed to always have more strict or more conservative rules than the IRS. They can never be more lax, but they can always be more conservative than what the IRS says. chances are they may not let you take it out. It's possible because it may be deemed a in-service distribution, which a lot of 401k plans don't allow, meaning so long as you're still working there, you can't take the money out. Maybe your plan provider has an exception and will let you take out Roth contributions. Don't know. You'd have to look into your plan. But just know for IRAs, you can always take out your contributions. For Roth IRAs. For Roth 401ks, potentially, but not necessarily. So that's contributions. Sorry, just looking at these quick questions here. So Marianne just commenting on Tommy's comment. So yeah, we'll table that for now. Dean asks, when you take out the original basis, does the 5-year rule apply? No, Dean. For contributions, no. There is no 5-year rule. Again, contributions. We didn't get to conversions yet. That's a different story, and I think that's where you may be going. But so I'm only, how old am I? I'm 42. I'm not 59 and a half yet, which we'll discuss. If I opened a Roth IRA yesterday at 42 years old, it's my first Roth ever. I put in my full $6,000 annual limit, and I can turn around and take that $6,000 out tomorrow. No tax, no penalty, no special waiting period, because that's my contribution. It's always mine. I can take it out at my leisure. Now, if that grew to, I got some awesome stock and it went up 20% in the course of a day. If it grew to $6,000 between yesterday and today, I could still always take out that up to $5,000 anytime. No tax, no penalty, no waiting period. That additional $1,000 is where some rules and things come in, and that's what we're getting to. So, good question. So that's contributions. Taking out conversions is a different story now. And this is where things start to get hairy. And it also, and recall that in the order of withdrawals, all contributions, all money that comes out are first deemed to be contributions. Once you exhaust taking back your contributions, then you move on to conversions, specifically those which were taxed when you did the conversion, and then followed by those which were non-taxed when you did the conversion. So when you do a taxable conversion, so let's some quick numbers to this. And I know this isn't the ideal venue to be talking about numbers because things can get a little, I should probably have like a whiteboard or something here to show it, but I'll try to keep the numbers simple. Let's assume again, I started an IRA yesterday, Roth IRA yesterday, has no money in it, and I do a traditional taxable conversion, meaning I take, let's say, $5,000 that I have in a regular traditional IRA that I never pay tax on. It's a regular tax-deferred IRA. I took $5,000 from it yesterday, converted it to my newly opened Roth IRA yesterday. I'm going to owe tax on that $5,000 conversion this year. Let's assume I'm in a 20% tax bracket to keep it easy. So I'm going to have to pay $1,000 in tax at the end of the year or this quarter if I need to make estimated payments. That's outside the scope of this thing, whether or not to actually do estimated payments. But I'm going to have to pay tax this year. So that's a taxable conversion because the money was never taxed from where it was coming from. I had to pay tax when I moved it into the Roth. Taxable conversion, $5,000. Now it starts to have a window, a 5-year clock on it. And this, I think, Dean, may be what you were asking. There's actually 2 5-year rules that come into play with Roth IRAs. One applies only to taxable conversions, which is what we're talking about now. So that $5,000 I just converted yesterday, it needs to sit there for at least 5 years before I can take out the amount I converted. If I take it out sooner, there's potentially or will be a 10% penalty on it. Even though I did the conversion yesterday, July 7th, for purposes of this 5-year clock, it's assumed that I did the conversion on the first day of the year. So whether I converted some point in February, March, May, June, doesn't matter. Any of those conversions would have been assumed to have happened on January 1st of this year, 2020. That's when the 5-year clock starts on any conversion done in 2020. So now I can't take that money out for 5 full years. So that's all of 2020, 21, 22, 23, 24. On January 1st, 2025, I've met my 5-year holding period for that conversion done in 2020. So at that point, I can then take out the $5,000 I converted, tax-free, penalty-free. It's always going to be tax-free anyway because I paid tax on that when it converted, but there may be the 10% penalty if I don't wait out at least 5 years from when I did that conversion. It's starting to get a little tricky, but hopefully that makes sense. And this is all summarized again at a slide in the end, because I realize these rules get a little unwieldy, so the slide will pull it all together neatly. Now, each conversion has its own 5-year clock. Well, actually, I guess every conversion done in the same year is going to have its own clock, because again, whenever doesn't matter what day of the year you did it, it's assumed you did it as of January 1st for purposes of counting the 5 years. So let's just assume you only do one conversion a year. This year I do one in July, so that clock's going to start January 1st, 2020. So again, that's not seasoned until 2020, 21, 22, 23, 24. Until 2025, I can't take that money out. Let's say next year I do another conversion, so March of 2021. I can't touch that one until 2026, when that has sat 5 full years. So every year you do a conversion, there's a new 5-year clock that happens. So if and when you need to take that money out, you should ideally wait 5 years. Otherwise, you may be hit with a penalty, 10% penalty. So let's talk about that. 5-year rule for conversions. Which this is backwards. Where am I? Okay. So there could be, and there's never when you take out amounts you converted, you'll never have to pay tax on the converted amounts because they were already taxed when they went in or prior to going in. But if you may have a penalty for taking that converted amount out, unless it was a non-taxable conversion. Again, this is starting to get a little technical, and I apologize, but this is a technical matter. Unfortunately, there's not an easy way to sift through it. If the conversion was non-taxable when you first did it, meaning it came from money that had already been taxed from whatever account it was sitting in, then there's no 5-year period that applies. You can take that money out whenever. Basically, you can treat this as if it was a regular contribution. You can take it out the next day if you want to. If it wasn't a double negative, if it wasn't a non-taxable conversion, meaning it was a taxable conversion, that is one that you did have to pay tax upon doing the conversion, this is where the 5-year rule comes into play. So we just discussed that. Until the conversion has sat and seasoned for 5 full years, starting on January 1st of the year you did it, you can't touch it unless you're 59 and a half. Then the 10% penalty goes away. So let's put some dates to this. So let's assume you are 57. There's nothing in your Roth IRA currently. You do a $5,000 Roth conversion that's taxed upon the conversion. So that's a taxable conversion. You're 57. That is subject to the 5-year seasoning period before you can take it out. But you're going to hit 59 and a half, 2.5 years in, let's say. Once you hit 59 and a half, you're good, you're set. You don't have to ride out those other 2.5 years of your 5-year clock. The 5-year clock stops and goes away the second you hit 59 and a half, the day you hit 59 and a half. You can then take out that converted amount tax-free and penalty-free because you've met the condition. Again, the condition was 5 years or 59 and a half. Whatever comes first is the better way to think about it. Makes sense? So that's for taxable conversions. Just looking here, there's a few more questions. Debbie, does the 10% penalty apply for those of us over 59 and a half if we withdraw a taxable conversion prior to the end of the 5-year? No, I just answered. Yeah, realized I didn't read your question until I was done talking, but no, the 10% penalty does not apply. Again, you could have done the conversion when you were 57, 58, whatever. As soon as you hit 59 and a half, boom, you're good. It's deemed that you satisfied your 5 years, and that penalty idea goes away. Layla, do we also pay state tax on conversion? Yes, if you're in a state that has income state tax. So a handful of states don't. Florida, for example, in that case, no, you wouldn't. But assuming you do have income tax in your state, yes. I don't know all 50 states' taxes, well enough to say this with certainty, but I'm pretty certain any state that has income tax will most likely tax you on this or add it to the rest of your taxable income. Good question. Celeste, my hubby is saying to me, tax laws can change in the next 5 to 10 years. Why bother to worry about it now? Great point. I'm convinced they will change. And if I had to bet, they're going to change for the worse, meaning they're going to get higher. So Celeste, one thing we know for certain, the tax rates we're in now, generationally low, historically low. This is fact. They will increase in 2026 to what they were prior to when they decreased in 2018. This was part of the Tax Cuts and Jobs Act. So the tax rates we had in 2017 got bumped down by a few percent each up until the end of 2025, at which point, starting 2026, they go back up. That's certain. We know that's happening. So it's an objective statement when I say we know tax rates now are lower than they will be in 6 years and beyond. And yes, tax legislation is always subject to change. And on top of those changes that are already due and scheduled to happen in 2026, I'm quite confident taxes are going to have to go up even more beyond that, again, for no other reason than the stimulus, trillions of dollars of stimulus that were created to help try to minimize the damage to the economy. That has to get paid off. That was created by just printing government debt. Taxes are going to have to go up, in my opinion. Now, not to make this political, but as soon as the presidency, the House, or the Congress or the Senate all trend or change to be more democratic, chances are taxes will go up, maybe not necessarily more, but sooner. So like the Tax Cuts and Jobs Act that are due to revert in 2026, depending on the upcoming election, maybe they revert sooner. Maybe that they get pulled forward and tax rates actually go up starting next year or 2 years. I don't know. Subject to change. But yes, we don't know what's going to happen, but I'm pretty confident in saying chances are much better that taxes will go up as opposed to go down. So if that's a feather in the hat of why you'd consider doing conversions now, because taxes are most likely lower than they will be in the future. Just looking at other comments here. Tommy, how do you know when your withdrawals have gone past your contributions and you've started withdrawing conversions? Just keep track of contributions versus conversions in the spreadsheet. Good question. Yes, you can do that. The Form 8606 in your tax return is what tracks all this stuff. That is your record keeping. That gets filed with your tax return every year. And if you don't have to file a return for whatever reason and you have Roth activity, you still need to file the 8606 as a standalone form with the IRS so they can keep tabs on it as well. So that's the formal record keeping. Can't hurt to do it in a spreadsheet as well, just so you know, but that basically will track your basis, your conversions, and everything like that. So good question. Mark, if I have a 5-year-old Roth IRA, can I do Roth conversions and put them into the 5-year-old Roth? I was told as long as you have one Roth that is 5 years old. Okay. Hold that question. I'm going to address that next. This should answer it. And then Chris asks, is there a 5-year rule on the gain/profit? Yeah. So let me get to that. All right. So we discussed withdrawing contributions, always tax and penalty free, no special holding period or whatever. Your money, take it out whenever. Boom, done. Conversions, depending whether it's a taxable or non-taxable conversion, you can either take it out whenever, in the case of conversions which were not taxed, or there is a 5-year seasoning for each conversion that you do, or every year you do conversion, I should say, where you can't take that out without a 10% penalty inside of the 5 years, or if you hit 59.5 first. Finally, so again, going down this order of withdrawals, we went through contributions, we went through both conversions. After you've taken out all of your original contributions and all of your conversions, all that's left in your account is earnings. So how and when can you take out earnings? You can take them out whenever, but they may be subject to tax and or penalty. If it's what's called a quote-unquote qualified distribution, there's no tax, no penalty. So what makes something a qualified distribution? What side am I on? Yeah. All right, so this is the other 5-year rule. The first one we discussed is each year of conversions has its own 5-year clock before you can take out that conversion without penalty. The second, and I'm going to call it unrelated 5-year rule, is how to take out the earnings without tax or penalty. That is, you need to satisfy what's called a qualified distribution. There's 2 things you need to do for that. One, you need to have open and funded any Roth IRA for at least 5 years. And like with conversions, that 5-year clock starts on January 1st of the year you open and fund your Roth IRA. Okay? So you have an account open and funded. It could be only $1, but there needs to be something in it. You can't just open an account and let it sit. There needs to be some kind of money in it. As long as you've had that account open for a full 5 years, you've met condition 1. Condition 2, one of these things, sorry, I'm a little sideways. One of these things need to happen. Either you're at least 59 and a half, and you meet this the day you turn 59 and a half, or, now this is getting slightly off track, but if you die, whoever inherits your account, distributions then are automatically qualified. So if you open a Roth at 50, you die at 56, you met this the account met the 5-year rule because it's 6 years later, and you die at 56. You didn't meet the 59 and a half, but because you died, the IRS will not penalize your heirs for taking money out. It's qualified. They can take it tax and penalty free. The other exception, so let's say you're not 59 and a half, you didn't die. The other exception, or the other thing that would make it qualified is you can take out up to $10,000. That's a lifetime limit for the purchase of your first home. Now, there's a lot of rules and conditions around that, but easiest way to think about it, if you've never owned a home before, it's not quite that simple. But let's assume you never owned a home before, you want to go buy a house, you can take out up to $10,000, tax and penalty free, as a qualified distribution. Now, keep in mind, you can always take out your contributions. So we're really just talking about the gains. Any gains you've had in your account is what we're talking about here. Because contributions, remember, they can always come out tax and penalty free. Conversions, they can come out tax-free, may or may not have a penalty. If and when you've taken out all contributions and conversions and all that's left is gains in your account, that's when you need to start worrying about this stuff, right? So that's when you can take out $10,000 of gains, basically, in your life to help buy your first house. The other condition, if you don't meet any of these three, if you're totally disabled, you can take money out tax and penalty free, even if you're not 59 and a half, etc. So there's a full formal IRS definition of what totally disabled is, but it's as the name implies. You really need to be totally disabled, not capable of doing any gainful employment, I think is the term they use. So anyway, so if you've had your account at least 5 years and one of these 4 bullets are true, you can take out all of your gains in your account tax and penalty free because they're a qualified distribution. So now for most people, this simply means you got to be at least 59 and a half and your account needs to have been open and funded at least 5 years. If you met both of those, you're golden. Everything that comes out of your account ever is going to be tax and penalty free at that point. So 59 and a half, account's at least 5 years old. That's sort of the rule of thumb. These things are just the other exceptions, but generally it comes down to 59 and a half and 5 years. So what does that mean? Planning opportunity. I can't give specific advice, unless you're one of my clients under formal agreement. So just consider. If you don't already have a Roth account, might as well open one. Start the 5-year clock. You can put as little as $1 in it. Most likely, the custodians may require a little more, but it's not like you need thousands of dollars. You can open an account, put in $50 or something. Now that assumes, again, you have earned income, so either you have a job or you're self-employed. And it also assumes you're not beyond the income limit of $206,000 for married couples or $120 something for single. So if you don't already have a Roth IRA, may as well open one, assuming you're eligible to, just to start the 5-year clock. Because again, you need to meet that 5-year clock and be 59 and a half or hit one of those other criteria to eventually take your money out tax and penalty free. So Mark, I think that answers your question. If you have a 5-year-old Roth and you put conversions, I was told as long as you have one Roth that is over 5 years old, any more Roth money you put into that 5-year-old Roth is not subject to a 5-year rule. Sort of. So again, there's 2 5-year rules. One is each conversion has its own 5-year clock attached to it. And then separately, the Roth IRA account itself has a 5-year period that needs to be met before distributions of earnings are deemed to be qualified and therefore tax and penalty free. Now, I mentioned, again, this isn't specific advice, but no harm in opening a Roth if you don't already have one to get your clock started. If you already have a Roth 401k at work, that clock and the time you've had that open, unfortunately, will not port over to a Roth IRA. So let's say you're 58, you've had a Roth 401k at work for 10 years. You leave that employer and you want to roll over your Roth 401k into a newly opened Roth IRA at 58 years old. Great. But the 10 years you had the Roth 401k open doesn't matter. For purposes of the IRA, you're starting fresh at 58 when you open that Roth IRA. Even though the 401k has 10 years behind it, doesn't matter. So that's why I'm saying, like, if you don't already, it can't hurt to open a Roth IRA just to start your clock to make sure you get that 5 years out of the way, because 401k time does not port over to IRA. So Chris, is there a 5-year rule on the gain profit? So yes, that's what we just discussed with qualified distributions. There's one other slide I want to get to, but let me see what other questions there are here. Debbie, do the rules differ when rolling Roth 401k to Roth IRA in terms of the 5-year clock? Exactly. Good. I should have looked at your question, but yes, the rules do matter. Again, the time you had your Roth 401k open does not translate and port over to opening up your Roth IRA. Ken, if I convert some non-taxable IRA funds each year, does every conversion have its own clock? Yes. Every conversion done in a given year has the same clock. So every conversion you do in a given year is deemed to have happened at January 1st of that year. So yes and no, every conversion has its own clock. So if you did a conversion in February of this year, one in May, and one in July, today, you did 3 conversions. But all 3 of those are deemed to have been done as of January 1st of this year for purposes of meeting their own 5-year clock. So all 2020 conversions need to sit and simmer for all of 2020, 21, 22, 23, 24. Not until 2025 will the 5-year clock have been met on those 3 you did this year. And then if you do, whether you do 1 or you do 100 conversions next year in 2021, all those conversions need to sit and simmer until the end of 2025. So then starting 2026, they will have met their respective 5-year clock. So every year has its own clock. It's not really that every conversion, every year has its own 5-year clock. Ken. Layla, is there an age where you can no longer do conversions? Nope. Anybody, any age, of any income level, whatever, can do a conversion. There are, I want to say, literally 0 restrictions to who can convert and how much. Now, maybe there's some esoteric, obscure restriction I don't know of, but generally speaking, yes, anybody can convert at any time, at any amount. Now, keep in mind, you need to have the money to pay the taxes when you convert. If you convert $1 million this year, that's going to be a real chunky tax bill on that conversion, a few $100,000. Make sure you have that cash available to pay that tax, but otherwise there's 0 limit on who can convert, when, or how much. Trevor, I have a Roth for 15 years and did a Roth conversion at 66. So do I still have to wait 5 years before I can remove converted amount? No. You're over 59 and a half. That 5-year clock idea on each conversion goes away once you're 59 and a half. Now, and here's why, and this is interesting. It's a little deep, so try to stick with me here, but when you have money in a regular tax-deferred account like an IRA, so let's say you're 20 years old, you put in $5,000 into a regular IRA, you did not pay tax on it yet. You also, any money in that IRA, you can't take out until you're 59 and a half. If you do, there's a 10% penalty. And I think everyone knows that, right? So here's why there's that 5-year clock on conversion. So if you're 20 years old, you have until 59 and a half until you can take out money without the 10% penalty. If you were able to convert money today, let's say that $5,000 that you originally have in your traditional IRA, if you were able to convert that today, you'd have to pay tax. Everyone knows that. Everyone realizes they're not getting around tax. But in theory, you'd be able to then take that money out the next day with no additional penalty other than you would have paid the tax. So the IRS doesn't want people using conversions as a way to circumvent the 10% early penalty in tax-deferred accounts if you're younger than 59 and a half. Now, What's interesting is they only do a 5-year clock. They don't make you wait until you're 59 and a half to avoid the 10% penalty. They only make you wait 5 years. So if you want to look at it that way, they're being kind of generous. So you can sort of circumvent the 10% early withdrawal penalty in traditional tax-deferred accounts by converting, but you have to wait at least 5 years or until you're 59 and a half. So that's why the 5-year rule stops applying once you're 59 and a half. Even if you've only had the conversion done for 2 years, once you hit 59 and a half, the 5-year rule goes away. Because had the money still been in the traditional tax-deferred account, at 59 and a half, there's no more early withdrawal penalties, period. There's no more 10%. That's why in the conversion world, in Roth world, once you hit 59 and a half, the concept of 10% early withdrawal also goes away, even if you did not meet the conversion's 5-year clock. Make sense? It's real thick and technical stuff, but I think it's interesting to understand and appreciate why there's this 5-year waiting period on conversions. It's basically so you can't completely skirt around having to pay early withdrawal penalties if you were to have taken that money out of a tax-deferred account. Hopefully that helps. Okay. So that was qualified distributions. Again, this applies to once you get to the point where you're finally withdrawing earnings from your account. You need to have had the account open at least 5 years and be one of these. Usually 59 and a half is what most people hit. What if it's not a qualified distribution, but you still want or need to take those distributions out, take those earnings out for some other reason? Well, there's exceptions to the 10% penalty. If it's not a qualified distribution like we just saw, you're still going to have to pay tax on the earnings, but there are ways to get around the additional 10% penalty. And there's a lot of these, so don't get too hung up in it. But so even if it's not a qualified distribution, you can still get around the 10%. Sorry, where are my fingers here? There we are. You can still get around the 10% penalty if one of these things happen. So again, 59 and a half, or you die unfortunately, and your heirs start taking money out. First time home, again, $10,000. Totally disabled. Or here's where things start to get a little complicated, and I won't dwell on these too much because these will start to get really technical, but there's something called a series of substantially equal periodic payments. And this applies in the regular IRA world as well. So normally, as you know, you can't take money out prior to 59 and a half without a 10% penalty. Just like in a Roth, you can't take the gains out prior to 59 and a half without paying tax and a penalty. But if you take out payments structured in a way that they last at least 5 years or until you're 59 and a half, those get around early withdrawal penalties in either traditional or Roth IRAs. It's really technical how to set these up. I don't want to dwell on it too much, but basically the gist is there is a way to get money out of your accounts early and avoid the 10% penalty. Later on in the summer, I'm doing one of these live sessions just about IRA exceptions to early withdrawal rules. We'll talk about the substantially equal payments later then. Anyway, another one, if you have medical expenses that are greater than 7.5% of your adjusted gross income, you can use distributions of your Roth earnings to pay them. You'll have to pay tax on those earnings if they're not qualified, but you avoid the 10% penalty. Or paying higher education expenses. Again, you'll have to pay tax if you're taking out your Roth earnings early, but you would avoid the 10% penalty. If you get a IRS levy slapped on you and they tell you, hey, guess what, we're taking your money, you avoid the penalty. And finally, this only applies to those in the military reserves. There's a certain type of distribution called the Reservists Distribution that also you'd have to pay tax, but would get you out of having to pay the 10% early withdrawal penalty. Okay. I think that's it. Just looking for a final question. Tommy, thanks for your answer to this. I understand how you can use the 8606 to track conversions, but I didn't think it also tracked Roth contributions. Yeah, you know what? You might be right with that, Tommy. So it does and it doesn't. It doesn't explicitly say, I don't think it explicitly says I contributed X dollars this year. What it does do, though, when you make withdrawals, there's a section on 8606 to put in your Roth withdrawals for the year. And then it starts asking you a series of questions. How much of this was original contribution? How much of this was conversion, etc.? So you're right. I guess it's not directly tracking contributions, but it's making you reference your contributions. So yes, you do need to track yourself somehow. Now, separately, I'm trying to visualize one in my head. Every year from your custodian, you should get a form, what's it called? 5498. I'm drawing a blank. I forget what it's called, but you'll get a form from your custodian showing the balance of your Roth accounts. And I believe that shows the basis, aka your contributions. So that could be you, assuming your custodian does track and show that, that could be used as your official tracking of contributions. Or simply, again, do it in a spreadsheet. I mean, it can't hurt to do that anyway. So if you have a secondary tracking method, if nothing else. Okay. So I'm done with the, right. So I'll get to the last few questions. Just want to share, like I said, I apologize. This was all a lot more technical and convoluted than I envisioned it being when I set out to want to discuss this, until I put pen to paper and started thinking through how best to explain this. I realized, wow, there's not a clean and easy way to do it. But I boiled all this stuff down. Let me get this straight here. Into this little chart, and don't get too hung up on this. You don't have to screenshot it. I will share this with the group, but basically it says, here's all your different withdrawal types. Was it qualified? Then these will apply. If it was qualified, will it be tax? Will it be penalty? And you can see it's no in all cases. If it was non-qualified, well then, do you have a 10% exclusion? Yes or no? And then you just follow down the columns. Okay, no. So for example, like line 2, you're taking out a taxable conversion. It's not qualified, so it's non-qualified. Do you have an exception? Let's assume no. Will there be a tax? No. Will there be a penalty? Yes. And then here's that little footnote. It says, each conversion has its own 5-year clock. If you take it out within 5 years, you'll have to pay 10% penalty. So this little chart here sums up all the technical terms and big words and mumbo jumbo I just said for the last 50 minutes. But without going through that mumbo jumbo, I don't think this summary slide would have been that helpful. So that's why I saved this to the end to first walk through all the pain of discussing these rules. So this would hopefully make more sense. And again, I will share this with the group, so you don't need to follow up and ask me for it. Okay, so that's all I got. Let me hit these last couple of questions here. Okay, Trevor, convert 200,000 IRA to Roth IRA and pay tax from brokerage account, and I'm 66, so I don't have to wait 5 years to remove money. Nope. Now, again, assuming what you're removing is that converted amount, no. Remember, all withdrawals from a Roth first exhaust your original contributions. Once you burn through those, then it's your taxable conversions, and they're done in a first in, first out basis. So if you've done conversions every year for the last 8 years, you first start taking out that conversion you did 8 years ago, the most seasoned one. After you deplete that, you did the one you did 7 years ago, 6 years ago, 5 years ago, whatever. But no, since you're over 59 and a half, there will be no 10% penalty. You don't have to wait 5 years to take that converted amount out. Gains on the conversion may be taxable unless you've had the account open more than 5 years. Because remember, gains need to be a quote-unquote qualified distribution to be tax and penalty free. So Trevor, if your Roth account is more than 5 years old, then you're good. You can take out any money from any source, contribution, conversion, earnings, anytime, tax and penalty free if the account's more than 5 years old, considering you're 66. Marianne, I don't think I ever filed an 8606. Not the end of the world. You can, I've never done this, but I've heard it works in practice. You can simply just send them in. Or what you can do is the proper answer is you're supposed to do one for every year you missed and send it in. That's my formal guidance to you. The informal guidance, now do this at your own risk. I've heard that if you've missed 5 years of sending in Form 8606, you can simply do one now. Just make sure it reflects accurate information, as if you kept track of everything properly along the way. Send it in now. The IRS, I've heard anecdotally, has been cool with it and hasn't taken any action against it. So that's at your risk. The right answer is you should retroactively file one for every year you should have. And that's my formal answer, and I'm sticking to it. Kathy, does the custodian typically have the answers to the questions the IRS would ask on 8606? I've done a bunch of conversions with no withdrawals from the Roth as of yet. Let me think about that. They should, yes. Now, honestly, I don't know with Fidelity if they have something to, neat and pretty spoon feed you that shows exactly the information you need as you need it. But yes, in theory, you can go back. You may have to ask some questions and talk to some different people, but they have records of all this stuff ultimately. So worst case, you may have to backtrack and piece through it yourself. But yes, you can ultimately get whatever info you need from Fidelity in one way or another. And finally, there's a new one. Let's see. So Mary, I think it's pretty common to not file one. As far as I know, you only need 8606 if you do a Roth conversion, non-deductible traditional IRA contribution, or a Roth distribution. The last one isn't, yeah. So what Tommy said to you, Marianne, I believe is right. Simply making a contribution to a Roth, a regular contribution to a Roth, does not require an 8606. And again, now I'm thinking through this out loud. That's because contributions aren't actually tracked, like Tommy pointed out. What is tracked is conversions, definitely. Withdrawals, definitely. So if you ever do a conversion, Roth conversion, or ever did a Roth conversion, or took a Roth withdrawal, then there should have been an 8606 filed in those respective years. Layla, I'm confused now. Not surprising. Very confusing rules. The fact that there's 2 different 5-year rules does not make it easy. But yes, this stuff is all very complicated. The harder you think about it, the more you come up with scenarios like, wow, wait a second. How does this fit now? So let's see. If I have a Roth IRA that is already 5 years old and I'm past 59 and a half and I do a conversion this year, will I have to wait 5 years to withdraw? No. So the golden ticket with Roth IRAs is once the account itself is over 5 years old and you're 59 and a half, you're set. You're set for life. There's no circumstance where you'll have tax or penalty on any withdrawal at that point, regardless what you're withdrawing or whether it was contribution, conversion, or earnings. Accounts more than 5 years old, you're 59 and a half or greater, you're set. No restrictions on anything with what you take out. You can also contribute. There's no age limit on contributions. Again, you need to have earned income though, so unless you have income from a job or you're self-employed, you're not eligible to make a Roth contribution. You can still convert at any point in your life, regardless of income or lack thereof, but you can only contribute if you still have earned income. But in theory, if you work up until you're 90, you can keep contributing up until you're 90. I guess I don't know why you would, but in theory you could. Marianne, I contributed to traditional 401ks in the late 80s and through the 90s, then never contributed again. I couldn't get that information as Vanguard only has a cost basis to 2012, so I couldn't gather all this info for an 8606. But for purposes of an 8606, Marianne, contributions to a traditional 401k or IRA wouldn't matter because that's all one big homogeneous pot of tax deferred money. It doesn't matter when you put it in. Only when you convert it from a traditional to Roth will that conversion need to hit that year's 8606. So simply because you contributed to 401k or IRA doesn't mean you needed any sort of special tracking or 8606, if that makes sense. Only when you convert to a Roth IRA or take withdrawals out, that's when you need to start 8606ing it. Okay. I'm trying to convert all my traditional. Right. So, Marianne, yes, I'm trying now to convert all of my traditional IRAs over to Roths now, so I wouldn't have the necessary information. Again, it doesn't matter the contributions you originally made to your traditional tax-deferred 401k or IRA. You don't need to have tracked those. It doesn't matter when you put the money in. Again, it's all one big pot of tax-deferred money. Whether you put money in 1985 or 2018, doesn't matter. There's nothing special you would need to track that. Whether you, if it's $500,000, it is what it is. It doesn't matter if there's shares in there you bought 20 years ago or shares you bought yesterday. $500,000 of tax deferred money is $500,000 of tax deferred money. It really doesn't matter what the stuff is in there. Now, when you convert, you will need to, again, to track the conversion in the year of conversion by way of Form 8606. But the fact that you've been contributing to a tax deferred account for years, I don't say it doesn't matter, but you don't need any special record keeping or tracking or info of what and when those contributions were, because it doesn't really matter at this point. It's just one big pot of tax deferred money. Hopefully that helps. Shauna, is there a bad reason to not convert all of your traditional IRA? Just simply, well, depends. A lot of answers are going to be depends. If you do convert it all, I wouldn't necessarily do it all in 1 year. First of all, obviously, because that's going to really spike your income. It'd be better to dribble that out over multiple years to try to keep your taxable income relatively low each year instead of monstrously high 1 year. But should you convert all, even if you can do it in multiple years and multiple steps? Maybe, maybe not. Again, going back to the seesaw analogy, everything you do to help the present day you takes away from the future you, and vice versa. Now, I feel like, and it's tough to quantify the right answer, but the goal is kind of to get to retirement in a point where you need to start distributions, having a good balance of money across tax buckets. So some in never taxable, like Roth money, it's already been taxed, will come out tax-free. Some in like a regular brokerage account that may or may not be taxed, depending if you're taking out gains or losses or whatever. And then some in tax deferred. So now this is especially true if you don't have other sources of income that are always going to be there. Like if you have a lot of Social Security or pensions, it's good that you have those. But that means your taxable income is always going to be at least a certain level. So you may, once all those pensions and Social Security are turned on, you may not have any other periods in your life where you're at low income. So so maybe in that case, it would make sense to convert most, maybe even all of your tax deferred stuff to Roth while you can. But I don't think you should necessarily obsess about converting every single dollar over. It wouldn't necessarily hurt to have some. How much, it's tough to say what the right answer is, but there's value in the diversity of taxation. Why? Don't necessarily pay more tax now than you have to just for the sake of having completely zero taxable income in the future, because there may still be periods where you have relatively low taxable income down the road that it wouldn't hurt to have some tax deferred stuff then to fill up those low buckets. But no single answer to that. It's all going to be situation dependent. But yes, good question, Shauna. Marianne, my traditional IRAs was money I already paid tax on, and that money then I sent checks to Vanguard to add to the IRA. So you're saying I have to pay tax again on the original money and the growth. My traditional IRAs was money I already paid tax on. No. So, Marianne, you're saying it's all in an IRA. Some you originally contributed and some more you just contributed, right? That you already pay tax on. Sorry, right. I missed that point. That's a key point. No. So, and this is where things get tricky as well. You can have a traditional IRA where potentially all of it is money you never pay tax on, or potentially all of it is money you already pay tax on. Anybody can make a contribution to an IRA on a non-deductible basis, meaning you don't get the tax break for it when you put it in. Regardless of income level, anybody can do that. Not anybody can do a tax-deductible one because you get phased out if your income's too high. So it's quite common. Some people have IRAs where there's some money that was never taxed, some money that was already taxed. So Marianne, this is your question. I got it now. At least I think it's your question. So you have this IRA, some was taxed, some wasn't. When you eventually take money out, will you have to pay tax again on the money you already paid tax on? The answer is no. Here's where it gets fun though. There's something called pro rata or proration. For every dollar you take out of that IRA, it's going to be equal parts taxable and non-taxable in proportion to what your total account balance was. So let's say you have a $100 IRA, $80 of it was pre-taxed, never taxed money. $20 was money you already paid tax on. You take $1 out. That dollar is going to be deemed that 80 cents of it is money you have to pay tax on because it was never taxed. The other 20 cents you will not have to pay tax on because it was already taxed. Does that make sense? I think, sorry if I missed that in your other questions before. So then yes, getting back to your 8606 question, if you have been making non-deductible contributions to an IRA or non-deductible after-tax contributions to a 401k, then yes, that there will need to be some sort of record of that. Now the 8606 is what would normally track that. If you don't have it, you'd have to get it from your custodian. Now if you're saying your custodian does not have those records or that level of detail prior to 2012, that's a good one. I don't know. Either the onus is on you to somehow, and I don't know if you have to dig up like old checks or something to prove what you did on a deductible versus non-deductible basis, or worst case, just thinking out loud, worst case, maybe it's deemed that all of it is pre-taxed unless you can prove otherwise. They may put the onus on you to prove it. Otherwise, the assumption is you have to pay tax on it. I don't know. That's an interesting one if you don't have the records of that. I don't know the answer to that right now. Okay, we are at 9:07. I will take, let's call it 2 more questions here. What if you plan to be in a lower tax bracket in retirement so you don't necessarily need to convert if you plan to be in a low tax bracket? Yes, good question. Now, if you know with certainty your income and or taxes will be lower in retirement than they are today, with certainty, then sure. The conventional logic, which is true, is you would not want to convert now. You would rather pay taxes in the future. But it's impossible to say with certainty that your tax situation is going to be lower. And here's why. So not only you don't necessarily know how much income you're going to have, and if you have pension or Social Security, you know those with certainty. But if you have an IRA or whatever, you don't know how big that's going to grow to. I mean, hopefully it grows a lot. Good for you. But the more it grows, that also means the more you eventually have to take out and be taxed on. So that's one big variable. And then tax rates and tax brackets themselves, we don't know. It's impossible to know. Again, we know what they are now. We know what they're supposed to increase to in 2026. We don't know what they're going to be 5 years, 10 years, 20 years, 30 years from now. Again, my opinion is they have to be higher than they are now. So that leans me to want to say, take advantage of low tax rates now and consider some conversions. Getting back to Shauna's question, how much to convert? Tough to say, again, because we don't know. There's a lot we don't know. But there's definitely value in having diversity across the 3 buckets. Roth, regular brokerage, and tax deferred, like regular IRA 401k. So that when you do get to retirement, whatever the tax situation is at the time, you have some control where you pull your money from. You can manage your taxes a little better. That's sort of the goal with all this. But it's tough to nail down an exact answer because there are so many unknowns. And another thing to think about, Shuk, is that taxes in retirement aren't simply just your regular tax bracket, right? Regular income tax. There's other things that come into play, like specific to those 65 or older, is Medicare premiums. We touched on this a few weeks ago. The base Medicare premium is like $145 a month now, but depending on your level of taxable income, the higher it is, your income that is, the more extra premium you have to pay. That's an extra tax, for example, that applies in retirement that doesn't apply if you're younger than 65. And who knows, again, fast forward 20 years, who knows what tax legislation is going to look like. There could be new taxes, possibly retiree-specific taxes we're not even thinking about in our wildest dreams now, may come into existence down the road. So by having your money in different taxability buckets, you're kind of hedging yourself to deal with whatever comes up in the future, because it is a big unknown. Stacy, at what point is the prorate of the non-deductible contribution calculated? The data was contributed or the data was converted? Yeah, great question. I think, let's call it 80% sure. I think the proration is as of December 31st of the year prior to when you do the withdrawal or conversion. I'm trying to picture the form in my head. I want to say it's December 31st. So for example, you have an IRA that has some already taxed money and some non-taxed money. Anything that comes out of that, whether it's a conversion or a withdrawal, is going to be prorated between those two buckets of taxed or not taxed. If you do a withdrawal or conversion today, let's say July, I'm pretty certain the proration is as of the market values from December and the balances of the account as of December 31st, 2019. 80% sure. That's my final answer for now. Ken, if I put all my after-tax contributions to a 401k into a Roth IRA, is that a conversion? After-tax contributions. It is, but it's a non-taxable conversion. So there would be no special rules or whatever that you need to meet. Because the money was taxed prior to going into its first location, its after-tax 401k, if and when you convert that after-tax money to a Roth, you'll owe no tax in that process because the money was already taxed. So yes, it's a conversion, but it's a non-taxable conversion, so there's no special rules or 5-year thing you need to wait. You'd be able to take that money out whenever, Ken. Ileana, what exactly do we need to keep track of and for how long? If I do a conversion in my 30s but want to take out the money in my 50s, do I need to keep something for the next 20 years? The right answer is yes. Again, it's every year you do a conversion, you need to track it on what's called a Form 8606. That's part of your tax return. So if you do conversions or Roth withdrawals, you need an 8606 in that year, and that's what tracks it. The conversions, if you're doing backdoor Roths, we'll talk on this next week, it also tracks the basis you have in your regular IRAs, basis meaning non-deductible money you put in, money you already pay tax on into your IRA. That's tracked in 8606. So yes, you should have should be doing this form. And also, there's one last question here, Kathy. Even if you are lower when you first retire, once you get taking RMDs, you can easily get to a higher rate. Exactly. Yes. Thank you, Kathy. So that's I think this was last week we talked about this. The upside to tax deferred accounts is you get a tax deferral in the year you do it. So it helps you reduce your taxable income that year. It doesn't get rid of tax, it just defers it. It kicks it down the road. I guess it's a good problem to have, but people who have a lot of money in tax deferred accounts and ultimately don't need it, they're forced to take it anyway and pay tax on it starting now when they turn 72. It used to be 70 and a half. So if you already have relatively high amounts of income, taxable income, in your retired years, let's say you have 2 pensions and healthy Social Securities, you're still going to need to take RMDs, required minimum distributions, from your tax deferred accounts starting when you're 72, and those are what they are. So in the year you're 72, it's going to be it's 3.9% of what your account balance is. You're going to need to take it. You can't not take it. There's a hefty penalty if you don't. So that gets tacked on to your taxable income. So that's why it's kind of hard to plan with super precision decades out, retirement planning, because you don't know what your pot of tax deferred money is going to be. Therefore, you don't know how much and how big the RMDs are going to be, and you don't know what the tax rates are going to be at that point. So that's why, again, this concept of diversity don't go to extremes necessarily. Don't put all your money into tax-deferred accounts because you're going to get zonked in retirement with taxes. Maybe you do or you don't put it all in Roths now. Again, depends on the situation. When you get to retirement, I could almost guarantee you're not going to regret having a lot of money in Roths. So from that point of view, I guess ultimately it wouldn't hurt. I don't think anyone ever looked back and be like, darn, I wish I had less tax-free income, right? That's probably not going to happen. So I don't think it's the end of the world if you convert everything to a Roth or only do Roths, but I also think it's not bad to have some balance across the different account types so you can tactically pick and choose your sources of income when you get to retirement. But yeah, good point, Kathy. All right, so Marianne, good. All right, just last, what did Cody say here? Yeah, Cody's just responding to someone else. Okay, so it looks like we are all good. I think I got to all the questions. Again, Tommy, feel free to shoot me a message or pop in again next week when we discuss, what are we doing? Backdoor Roth contributions, which part of that is a conversion next week. So that's that. Ran over time. Sorry that this was helpful. Again, I know this is very technical and probably hard to digest. I did the best I could trying to make this clear and somewhat easy to understand, but I realized it was a bit of a struggle. Hopefully you still got something out of it. All right, thanks for joining. I will see you again next week. Take care.